Welcome, everybody. I am your host, Bryan Karp, aka Mailbox Money, with my co-host, the man, the myth, the legend, Anthony Loffredo, aka the Professor. We were on your favorite podcast, the Brick by Brick podcast, and today you are all in for a treat. You are so lucky. I have my man from Madison Specs, all the way from New Jersey, Moshe.
Thank you, Bryan.
Thank you, sir.
Thanks for having me.
Guys, selfishly, you could not even be here. I just wanted this opportunity to chop it up so much with Moshe for the last 3 or 4 years. I have a genius in front of you. I have somebody who has the power to save you hundreds and hundreds of thousands of dollars, hopefully for the Karp family, over the next few decades, millions of dollars. And we're going to unpack all of it today. Literally, if you're driving, pull the car over. If you're working out, bring down the speed a little bit. Take notes. Share this with everyone you know, because I didn't know about any of this up until 3 or 4 years ago. But I was always so baffled how the big real estate gurus and the big syndicators were always bragging and gloating and telling me how they were paying so little in taxes. And for some reason, I felt like I was still paying so much. But before we dive into that, Moshe, give us the first comic book. Where'd you grow up? How did you get into, I know you're a CPA and an attorney. You have all these amazing, backgrounds. Give us a little bit, about you.
Grew up in Chicago, Illinois.
I'm a Bears fan,
How are you?
Yes,
sir. Got a new coach, didn't they?
Yeah, they just did. The Lions offensive coordinator.
Okay, looks like a young guy.
We're hoping for big things this year.
First winning season since when? Since 85?
We can't talk about that.
Grew up in Chicago, cold winters.
Are you a Bears fan?
I am a Bears fan.
Okay, good.
Yeah.
There we go.
Cold winters, nothing like watching a football game in the freezing cold. Came out east probably about 25 years ago.
Okay.
Went to school out east. I was actually on the island, Long Beach, Long Island. So,
beautiful.
I was out there for a couple of years. And then went to school, got my degree in accounting, worked in New York City, high net worth individual taxation for 4 or 5 years. Small little business in Lakewood, Madison Specs. Specs is specialized property engineering consulting services.
You started it.
Which is what we do. Partner in the business.
Okay.
The founder is Joe Rosenbaum and Elliot Zaks and Eli Lobenberg. We've been around probably about 18 years.
Okay.
I've been with the company for 14 years.
Okay.
And
you guys specialize in?
So cost segregation. Again, specialized property engineering consulting services, which is Specs. That's the Madison Specs. And we'll get to Madison a little bit later, but that's the umbrella organization. And what we specialize in is cost segregation, also known as component depreciation. So the idea is, instead of looking at a building in its entirety, you look at a building as different components. So you break up the building into different pieces. We don't look at the building as one building, in which case, if you look at it as one building, you depreciate it over 27 and a half years or 39 years. But our team of engineers break up the building and we look at it as different components. That's the idea behind our service.
Is this something that has always existed in the tax code and people just don't know about it?
So it always existed in one way or another. There was always accelerated depreciation. It became very popular in 2017. That's really became popular. And I'll give you the background. You're always able to do a cost segregation study and then break up the building into what we call 5-year property and 15-year property. Your 5-year property are the assets on the interior of the building. So if we're working with a garden style multifamily, that would be your kitchens, your appliances, flooring, window treatments, cabinetry, countertops, carpeting, anything that's ornamental in nature under the code can be treated as 5-year property. Anything on the exterior, so think asphalt pavement, concrete curbing, parking bollards, flagpoles, playground equipment, that's all depreciated over 15 years. Okay. So pretty much, we're able to do a cost seg study, break it up into 5-year property, 15-year property, and then instead of depreciating it over 27 and a half years, in the case of residential property, 39 years in the case of a commercial property, we're able to take it over 5 and 15. What Trump did in the Tax Act of 2017 was he allowed for bonus depreciation. So what bonus depreciation did was any asset that's a 20-year asset or less, you can expense it up front.
What do you mean a 20-year asset or less?
So there are different, under the tax code, there are different.
See, I'm glad I'm recording this because I always have so many questions for you after, and I need to hear it multiple times.
There are different depreciable lives. So different assets qualify for different depreciable lives. There are 5-year assets, which again, that's all of our personal property. Let's say you buy a computer for your business, that's also going to be a 5-year asset. Then your 15-year assets are your land improvements, but then there are certain components that are treated as 20-year property. It's depreciated over 20 years. That's the tax life of this asset for depreciation purposes is 20 years. It may last longer than that. It may last shorter than that. But under the code, the amount of years that I could take that I allocate my expense for that asset is 5 years and 15 years. So anything that's less than a 20-year asset was eligible for 100% bonus depreciation. And this is for tax years 2017 through 2022. So pretty much any property that was in contract and closed before, I'm going to say mid-September or October of 2017, and December 31st, 2022, you were able to do a cost-seg study on it, break it up into 5-year property, 15-year property. The remainder was a long life asset, 27 after 39 year, and then just expense it out.
Okay.
Okay. So again, you had to go into contract and close on that property between that time frame.
Understood.
2023, it was phased out to 80%.
And that's because of what?
That was the tax code. That was the way Congress passed it.
Okay.
So we're still in the phase-out period.
Yeah, I'm very upset over the phase-out period.
Well, hopefully we'll get something good out of Washington over the next, over the next couple of months. 2024 phased out to 60%. Now in 2025 we're down to 40%, which is it's still more than zero, but I think what it changed the game in real estate investing in the sense that through depreciation, you were able to get back a big chunk of the capital that you put into the deal. So, if you put X amount into the deal and you're able to get that back through depreciation, in year one, it was almost like your capital raise didn't cost you anything. That was the idea. And I think it attracted, again, you have to qualify for it. So it doesn't.
So explain that to the listeners.
It doesn't work for everybody. So there are passive and active rules. Okay. If let's say you're a doctor, right? And your primary business is healing patients, or you're a dentist or an attorney, even an accountant. And then you go out and you invest in real estate. So the income and the losses from those real estate deals are what we call passive losses. You're not actively involved in the deal. Maybe you get a K1. K1 will issue some income, some losses, and that's the losses that are going to be generated from that deal as it relates to you are passive losses. Passive losses will not offset active income. Okay. So if I'm a W-2 employee or I'm a partner in a business and I have active income and then I just invest in real estate, so for the most part, those losses aren't going to translate into anything real for you. Okay.
So somebody who owns a piece of real estate, and you taught me this, it doesn't just have to be multifamily real estate. It could be a single family house that you rent out, right?
Correct.
So if somebody owned a piece of rental real estate and they were just a high W-2 employee, this wouldn't work for them because they don't have any.
Because it's passive losses. They're not actively involved. They're not a real estate professional.
Okay.
In order for it to really work, you have to be a real estate professional.
Right, which is, I don't want to say it, and it's funny because now he's our president, but it's almost like the Trump card, right? Like or a wild card in your deck is if you are a real estate professional, which, correct me if I'm wrong, I have 2 accountants in the room, and I'm not one, right? But I have to spend 51% of my time in real estate activities. Is that correct?
I believe it's an hours-based test. It's 750 hours over the year.
Okay.
And you have to materially participate. So there are certainly there are rules that you have to qualify to be a real estate professional. What I've heard, and again, this is just what I hear from my clients, is at times they'll have the W-2 income, and then as they invest in properties and the portfolio grows, the wife becomes the real estate professional. So the wife manages and operates the properties. She looks for the deals. She deals with the attorneys. Dotting the I's and crossing the T's as the transaction closes and proceeds. So the wife is the real estate professional. She will have the losses, and her losses will offset his gains. So they kind of married file joint. The beauty of the U.S. tax code is that he has income, she has losses, and they'll offset each other. I learned that many, many years ago. It was actually the first time I was exposed to it. It was an attorney from Louisiana, class action lawsuit attorney. So he'd win these lawsuits, and he came into big money,
pockets of money,
just huge pockets of money. And they went and they bought like triple net lease properties. They bought up across the South. They bought up vacation homes and triple net lease properties, and they used those losses to offset their income. And that was like the first time, like it just registered to me, like, hey, he's like, married, filed joint, Moshe. That's it. Wife's got the losses. I have the income, and we haven't paid taxes in many, many years. Now, keep in mind, it's a deferral. We're not negating your tax liability, right? You're deferring it to a later point in time. So you're front loading your depreciation today. And if you don't continuously buy properties and have depreciation expenditures, at some point the musical chairs are going to stop.
Moshe said to me this on a call, and even though I've never done drugs in my life, he said, you become a cokehead. And I said, what do you mean by that? He's like, as long as you continue to buy properties, you'll always be fine. You can't keep this charades going if you're not a serial purchaser.
You have to constantly buy. You have to constantly come into depreciation. So it could be, 1 year you value adding your property and come up with expenses that way. But just, from experience and being in the cost seg industry for 14 years, it's like coming off a high. Once you haven't paid taxes in years, and then you run out of depreciation and you got to start paying taxes again. So that's something that could be challenging. But as long as you keep it up, and I work with families, with clients, they do a deal a year, and that's the idea is the real estate professionals, however they come up with it. Another way I've seen it is they become passive in their own businesses. They kind of step aside from their own businesses. Maybe C Corp, and they just they'll get a dividend out of their business. And again, you have to speak to your accountant and get direction and and a letter ruling as it relates to your personal fact pattern. But they purchase a property a year to get that depreciation and to defer. And again, it's a deferral. It's not a tax shelter. It's not nobody's avoiding income tax. The idea is to defer income tax liability to a later point in time.
Right. But now, personally, I will never sell my properties without a 1031. So to me, I'm going to just continue to defer it until I die.
So that's the play. And we've seen families successfully execute that strategy where they've got operating businesses, pick a business, and they take the proceeds from their business and they'll put it into properties. And then they'll hold on to those properties, depreciate it, and then they 1031 exchange out of those properties and they buy bigger properties. They've got additional basis in the replacement properties. Again, because when you do a 1031 exchange, you're limited to your replacement basis, right? You can't double dip on your depreciation. So you've already depreciated the original asset.
Yep.
You don't get a full basis in the second property because that will be double dipping. But
break the basis down for me.
So there's a tax basis. Meaning, let's use
one of my properties. All right. I bought a house that you're doing one on this year, cost seg. I bought it for $180,000.
Okay.
I ended up selling it for $500, and then we did a 1031 exchange into a new property for $920. So what's the basis on those?
So it's hard to just put numbers to paper, numbers to mind, but the idea would be you paid $180,000 for that property,
yep,
and then you depreciated that property, let's say down to 90. So, and then you sold it now for 500.
Yep.
Right, so you don't have full $500,000 of basis in the replacement property because you already depreciated 90 of it down. You're limited to that basis of 180. Now, if you went from 500 to 900, so then you put additional basis in, right? You put additional cash in.
I had to.
So that fresh capital is eligible for depreciation.
Okay.
But what got you from your 180 to your 500, that's pretty much been depreciated down already. And I could do, your accountant is best suited to make that calculation for you, but that's something I could do back of the napkin for you. Pretty much if you give me the purchase price of the property that you sold, the relinquished property, the final year tax depreciation schedule, so I could see how much depreciation you took out of that property, as well as the closing statement when you sold the property, and then your purchase price for the new property. So with that information, for the most part, I could just jot the numbers down. I come up with a basis for you, but you're not going to have a full $900,000 basis in your replacement property because you've already taken some of that depreciation on your relinquished property. You don't get a full basis, a full tax basis.
Okay.
But But again, the idea is to buy, depreciate, exchange, buy, and then nobody lives forever. So at some point you leave those properties for your heirs, and then when they take over those properties, they're going to get a basis step up, and the first thing they're going to do after they get that basis step up is do a cost seg study so they can defer their income tax liability again. That's the beauty of real estate. It's all within the framework of the code. I always tell clients that the former president and the current president got bad news rap because he had hundreds of millions of dollars in losses, right? They got that first page of his 1040, but it was just smart tax planning. He 1031 exchanges, cost segregation, accelerated depreciation. As a real estate professional, he's able to utilize those losses to offset his income, operating income from his hotel empire and from his property empire, and he has losses. He has carry forward losses, but that's the I've done work over the years for a large syndicator from here out on the island, and he had partnered up with another group on a property, and I got a call like April 14th from his JV partner, and they said, Moshe, we've got an issue over here because I'll just pick a name. Steve said we need to do a cost seg study on this property. They bought a retail property together, and Steve said that if you're in real estate, you should never pay $1 of taxes. So let's do a cost seg study. There was a little bit of income out of the property, but he wanted that income gone. He didn't want to. For the current year, he wanted to defer that income tax liability, and we did it. We got the study done for him. But for the most part, again, if properly done and executed, you should be able to defer income tax liability for depending on what you buy, you should be able to defer your income tax liability.
I just think it's so interesting that there's families that are literally just buying an asset a year to be able to help mitigate their tax burden.
But that's the beauty of real estate and the benefits that Congress has afforded real estate owners. It's all in the code. I mean, 1031 exchanges. That's not that you need a QI, and you have to identify. And you have to close. You've got to close within your time period. Right? You've got 45 days and 180 days.
Yep.
But as long as it's done correctly, it's Congress gives benefit, and there's obviously it stimulates the economy. It helps the economy by transacting in real estate. So you've got these benefits, and if done properly, there's huge opportunity for real estate owners. We've got a bunch of clients like that where it's a deal a year. That's the idea. They've got, maybe they have their investor group and the investors are able to use the losses. If the property itself is generating income, you could use those additional losses to offset that income as well. Meaning, even if it's passive, so you'll be fine. If this property itself is generating income and I don't have sufficient depreciation expense from this property, then I could use those losses to offset my income, right? That will work as well.
Moshe, I have a question. Now, for a lot of the listeners that are just getting into real estate and they have that ability to potentially flip a property or, hold on to a property, depreciate it, and then sell it the next year for a profit, but don't want to pay those gains. So then they do the 1031. Now, after they do the 1031, if they need capital, are they able to now go get a loan against that property and have it be taxed and have no tax hit on that?
So that gets tricky. Meaning you're saying do the 1031 exchange and then just go for an immediate refinance.
Correct.
Okay. So I'm not. I know the question. I've been exposed to that, and I'm not suited to answer that. But I know it's a.
That you've
I
seen
know.
other
I know it's a
people.
strategy. Yes, where they'll exchange into the replacement property, and then they have equity in the replacement property.
Correct.
And then they just go ahead. I believe it is doable. It just has to be done properly. Yes,
Okay.
where do the 1031 exchange, have the replacement property, and then pull equity out. I think the challenge is if you pull equity out right before you do the exchange. That's my understanding. I think there's a challenge there. Again, I can't answer definitively, but I think there might be an issue if you pull out equity right before you do the exchange.
Okay. So pull out the okay.
Again, don't quote me on that. That's not my. We do have a QI. Madison 1031 is a.
Oh, really? So you guys are the
qualified intermediary. So I'm not involved in that business. It's not something that I do on a day to day. But Esther Rozansky and her team, they're top of class. They're a QI, and they're Dave Medinitz, Barry Neustadt. forward exchanges, reverse exchanges. There's, there's a lot of fun.
I've done a renovation exchange, which is really a lot of fun.
Yeah.
We purchased something, we still had an extra, $300,000 worth of capital. And I was like, I don't want to get taxed on it. So the 1031 exchange company held that capital and released it to our general contractor while they renovated this multifamily for us.
Right. You don't want to get hit with boot on it.
It was game changing. It really was. I guess when I'm looking, what's the best property to do a cost seg on?
So I always tell clients and prospective clients that the deal has to make sense. Losses are great, but if you're just looking at a property to get losses, you're going to end up with losses. That's not. You have to go in with a bona fide business plan, and the property has to make sense. You can't just look to buy a property just for depreciation to get losses. The deal's got to make sense. I always tell prospective clients, stick with the asset class that you're most comfortable with. So if you know single family houses and that's where you are, then that works for you. Your basis is lower. You may have to buy a little bit more to be able to achieve your goals. If you're a multifamily guy, you know how to deal with garden style or city walk-ups, then we were talking to a client years ago and they were looking to bring in an investor for the depreciation and it was all New York City properties. And the way it works with cost seg is the more assets that you have. If I look at a New York City property, a New York City walk-up, let's take a New York City walk-up where the building comes straight up to the street line. So there's no parking, there's no landscaping, there's no playground because the building comes straight up. So I'm not getting any 15-year property out of that asset. It's all 5-year property. I'll get you your kitchens. A lot of New York City buildings aren't grand either because it's hardwood flooring, which is treated as a structural asset as well. It's actual hardwood. The floating wood, that under the IRC, for the most part, that can be treated as 5-year property. Okay. Floating wood is good for a cost seg. The hardwood really is not good for the.
So it's great that I put floating wood in all my properties
because that can be treated as a 5-year property. But I'm telling the prospective client, I'm saying, it's a shame that you're buying in New York City. And he texts me quickly. He's like, Moshe, we are New York City buyers. This is the product that we have. Work with my product. So you ask me what's the best product for cost seg. So again, you got to work with your asset class and what you know. But as it relates to depreciation, gas stations, okay, the tax code, as long as it qualifies for under motor fuel rules, pretty much you carve out an allocation for land, and then the rest of that property can be depreciated up front. Property's gone. So let's say you buy a property for $1 million, gas station property or a car wash property. Let's just say, for argument's sake, you allocate 15% to land, left the basis at $850, and it's got to qualify. There's a percentage that has to come out of motor fuel sales, which my understanding is that most of these gas stations, that's where the money comes from. It's not coming from the convenience store. The convenience store is just it's just an add-on, it's just an extra.
Yeah.
But the money comes from the fuel. So a certain percentage of your revenue is coming from the pumps. Again, $850,000. You're in 40% this year, so you take 40% of the $850 up front. So gas stations work very well. RV parks, okay. I always tell clients, look for RV parks without parked owned homes. No, the less parked owned homes you have, the better, because then it's just pads. And the pads are 15-year property, and you've got some sewer systems in there, and the RV parks work great if you're just looking for, again, for a tax deferral. Climate-controlled self-storage, okay, is great because you have the climate control. That's 5-year property. Data centers, clients have done well with. And then just to point out, you get into the single-family homes, and really the Airbnbs and the VRBOs. So I don't know if you want to call it a quirk in the tax code, but what they allowed for was, even if you're not a real estate professional, Airbnb is a business property. So it's depreciated as long as you materially participate. So your guests have to be there for 7 days or less. And, as long as you materially participate in the management of that property, you could treat it as a business property, and you could take the costs, you could take the depreciation because it's a business asset, and I'll explain something else in a second, and you could actually use those losses to offset ordinary income. So again, going back to what we discussed earlier, even if I'm an attorney or if I'm an accountant, a doctor, or a dentist, if I purchase a short-term vacation rental and I have to materially participate under the code, I could use those losses to offset ordinary income. So over the last couple of years, I don't think I'd be exaggerating if I say that I've done hundreds of Airbnbs, Florida, Smoky Mountains, Bear Mountain, California, Nevada, Phoenix. It was just clients had gone, and I remember having a conversation a bunch of years back with an air traffic controller in LA. I mean, if you're still around, God bless you. Like, But he said to me, he said he makes like $200K a year and he's buying 2 Airbnbs. He's just going to knock out his tax liability. And like materially participate, manage it, operate it, and then, just knock out that liability. And I've done some big homes in Beverly Hills and in real expensive areas. We've gotten to these homes for $4, $5, $6, $7 million, and there can be huge depreciation out of some of those properties.
But it can't be their primary residence.
Primary residence is non-depreciable. That's your primary residence. It's not an investment property. It's got to be an investment property. For it to work, it has to be an investment property.
Which means what? They have to rent it out?
It's got to be rented out. Correct. Yep. It has to be, exactly.
Can you rent it out to yourself?
That's self-dealing. No, it's got to be, you have to have income out of it, and it's got to be, you have to have a depreciation schedule. You got to file a tax return for it. You show income, you take expenses. It has to be.
Meaning like if it was a second home for yourself and a vacation home and you Airbnb'd it sometimes and then you went down there and then you Airbnb'd.
That gets tricky. I take advice from your tax professional on that. That you want it to be above board. The idea behind these studies are to accelerate tax depreciation. What you don't want is you don't want to get audited on it. You want it to be above board, and you want all your T's to be crossed and all your I's to be dotted. And you want it to be a vacation home. You want it to be a rental property, and you just want it. You want it to hold water. You don't want it to. You don't want it to come back and get in trouble later.
Mo, you said the buck is like when you give me a breakdown, you show me year one depreciation, and that's what I look at. Am I still going to be able to use the 15 and the 20, or no? I'm just looking at the year one.
So your year one includes 5-year property and 15-year property, but I'm not eating up all your depreciation in year one. There's still depreciation left for later years. You're taking a bigger piece of it up front and less of it later on. There still will be depreciation. So again, depending on the basis, depending on how much you paid for the property, that's how much you're going to be left with in later years. But even if I'm carving out 25% or 30%, which is a heavy lift on these properties, you're still left with 70% of your basis for later tax years. There's still something left. Now,
are you able to take a piece of the bonus instead of the whole? So it's at 40 now. Are you able to say, okay, I'll take 20% bonus this year because I don't have as much income to offset?
No, that's not going to work.
You either take it all at once or
correct.
You don't.
So you don't have to take bonus. You could just do the cost-like study and take it over 5 and 15. You don't have to take bonus. Now, I do want to just for sake of clarity, the bonus does not work with all states. So the states don't necessarily agree with the federal. In New York State, bonus can be challenging. I'd suggest that you get proper tax advice on how to take the depreciation with bonus on New York State. Mm-hmm. I have clients that these studies can be done proactively. They can also be done retroactively. So, some of your properties, Bryan, you've done it in the initial tax year when you first bought the property. And then some of the other assets are properties that you bought in, let's say, 19, 20, 21. With Form 3115, it's a change in accounting method. You could take the cost-like study in later years, and then it's treated as an M1 adjustment on your tax return. So I have clients, and again, going back to syndication deals, I've worked with clients that they'll never do the cost-like study in year one. They'll always wait till a later period in time to do the cost-like, either because the property is not necessarily profitable in year one, so they don't need the depreciation. Yep. They've got startup costs. Something else I've heard from clients is that if it's a syndication deal, their promote doesn't kick in right away. So if their promote doesn't kick in right away, they really don't have an equity piece in the deal. And again, run this by your tax accountant. So if they don't have an equity piece, then they're not entitled to the depreciation. So instead of doing the cost-like study in year one and giving away all that depreciation to their investors, they'll do it in year 2, year 3, wait for their promote to kick in. God willing, the property does well and that promote does kick in, and then they'll be able to share in the depreciation at that point. So again, you can do it proactively, you can do it retroactively. And then one more point that I wanted to make was that even if you're not a real estate professional, these studies can be done for owner-occupied properties. So let's say I've got a business. Let's say I've got a warehouse business. I sell a product and I buy a warehouse for my business, medical supplies. As long as that property is used for my business, so even if I'm not a real estate professional, I could use the losses generated from a depreciation study to offset my business income.
Oh, really?
Because it's used to generate your actual income.
Correct. I'm a dentist, and I purchase an office condo for my dental practice. So I could take those losses that I generate through a cost seg study and use those losses to offset my dental revenue, my ordinary income.
I love it. I find this stuff so interesting. What I will just say to everyone, nothing that you hear on this podcast is tax advice, right? You should speak to your accountant. You should speak to your attorneys. It's just Moshe giving me advice for my own portfolio on it. But like what we did this year is I met with Moshe, I met with my accountant, and we looked at my previous 24 year. We saw how much income we were going to generate from the brokerage. And then we went through the portfolio and we plucked out the amount of depreciation I was going to need to pay very little in tax.
Now, again, I just want to point out as well, Bryan, that that with your accountant, we've determined that you're a real estate professional based on what you do, your job and your qualifications, and the properties that you own. So you're 100% above board and hold water. And then that's the model. Your clients always ask me, should I do all my properties right now? I had a call on my way in. We're looking at 2 multifamily properties in Illinois. I said, based on how much income you're projecting in 2024, that's how much depreciation. That's how much depreciation you should take. No reason to pay me a fee, and or pay a provider a fee for all your properties today if you're not going to do all your properties right now. Let's get this one done. This will offset most of your tax liability, and then come back in 2025 and do another property at that point. I want to make one more point, if I may, technical point, and that's that although bonus is phasing out, and if you're listening, President, we'd love to have bonus extended back to 100%.
I'm going to give him a call later, and I'll see if I can get it done.
If the property was purchased in a year that was eligible for bonus, so let's say the property was purchased in 2022, 2021, when you were eligible for 100% bonus, and I'm not doing the cost seg study until 2024, but because the property was purchased during a bonus year, with the 3115, you can still take that bonus depreciation.
In the current year?
On the 2024 tax return.
Wow.
You bought it during a bonus period. So
Did we look on my portfolio what years they were?
Yeah.
Sorry, guys. It's my podcast. It could be all about me.
yeah,
Okay, we did.
absolutely.
Which is, wow. So that's unbelievable. So if you were big buying in the years that it was 100% depreciation, you could still use that.
Correct. So if I didn't do the cost seg study yet, and I'm doing it now, with the 3115, I could take the bonus as well.
Okay. Yes. Now, another way somebody who is interested in getting involved in cost seg study could get this done without having to go out and physically buying a piece of multifamily real estate is they can invest in a syndication like what Anthony and myself have. Moshe, can you talk about how they would participate in that potentially?
So you can invest with a syndicator. The syndicator should be able to tell you based on the amount that you contributed to the deal, how much depreciation you'll be entitled to get out of that deal. So again, you work with a total capital raise, and then based on that capital raise, that's your ownership percentage, how much you put into the deal, and then I'll give an upfront estimate of how much depreciation I think I could pull out of the property, and this is just in the early stages when you're sourcing capital, and then take that same percentage, and the syndicator should be able to go back to the investor and say, look, you give me a check for $100,000, you should be able to get back, $50,000 in depreciation. So your capital contribution is not necessarily, it's costing you $100,000 out of pocket, but provided that you qualify, you should be able to get some of that depreciation back on the back end.
So it means if they made $50,000 off of that investment, it could potentially be deferred.
Correct. Going back, let's say like 2021, 2021, post-COVID, when the interest rates were at zero and the banks were lending like they couldn't get money out of the door fast enough. So what was common terminology in the cost seg industry and syndication industry was dollar for dollar. For every dollar that I give a syndicator, I want to get at least $1 back in depreciation. And that was feasible because your loan to value was so high between your debt and your bridge debt. Some of these syndicators were coming to the table without putting up $1, right? I mean, hopefully those properties are still doing well today, but that was the terminology. I'll put money into a deal and an LP will tell the GP, I have no problem writing you a check, but I'll give you $100,000, but I want $100,000 depreciation back. And it was feasible because, again, you get depreciation on your full purchase price, not based on the capital you contribute to the deal, right? So your depreciation's on your debt and on your equity. So if I'm doing a $20 million deal and I'm only putting up $4 million and my capital raise is $4 million, but I'm able to get depreciation based on a $20 million purchase price, then for the most part, back in the day, I was able to eat up that full $4 million raise with depreciation. Obviously, your loan to value has come down today, right? Nobody's giving you 85% today. Your loan to value has come down.
70, 65 in a tertiary market.
Yeah, and then your bonus has come down as well. It was two pieces. It was your loan to value and 100% bonus. So it was just like it was wild. It was today with your bonus down to 40% and your loan to value lower. So there certainly is benefit with the cost seg. There's certainly benefit of the depreciation on the syndication deals, but I think that the one-to-one is certainly a little bit more challenging to come by today than it was let's say 3 or 4 years ago. But there's still certainly heavy tax benefit in real estate between the cost seg and the 1031 exchange. There's certainly options to create and preserve wealth.
Yeah, without a doubt. I think the big thing for the listeners to know is they really have to either be the real estate professional or have their spouse be the real estate professional to really be able to get the gains out of a cost seg.
Correct. They have to work that out. Work it out with your accountant. Make sure that you really do qualify. You've got the Airbnb route, which is
that's a huge one.
Which is huge. You've got the owner-occupied property, which works as well, and then
owner-occupied property if you're running your business.
Running the business out of it. Correct. And then again, sometimes there are deals that the deals themselves are just positive cash flow, and you need that extra depreciation to offset that income. So in a syndication deal, if I'm positive cash flow year one, and the depreciation is not going to knock out that income, then do the cost seg study and defer the rest of defer the taxable income out of that property.
But what if somebody's investing in real estate and they're not a professional? Like what could they do?
So that gets tricky. The losses could offset the income from that property, but if they're not real estate professionals, then really the cost seg is it's not as exciting to them as it is to real estate professionals.
Yeah, like me, I was excited just because I love this cost seg but for me, it's just a win-win. But if somebody that isn't, like my brother, he invests in real estate, but he's not a real estate professional, it just doesn't help him and his wife being high W-2 income earners.
It's not going to help him. No. And then I deal with clients, I deal with doctors, lawyers, and I say, what kind of doctor are you? They tell me I'm a doctor of real estate. So they are doctors, they were doctors, I should say, and then they bought one property and they bought a second property, third property. So it's still something to look into. If it doesn't work for you today, as you grow your portfolio,
as you scale it,
and you scale up and you have more properties, at some point, you look and you're like, hey, I'm actually a real estate professional. I've got X amount of units. Most of my time today is going into real estate. So it could be slow go. It could be time to get there, but with planning, if that's your goal, it's certainly doable.
I know that I did my first cost seg during COVID, so it was great because I was able to go with my iPhone and walk around the properties, and I think it was you or one of your colleagues. But how are you guys doing it prior, and how are you doing it today? And let's just keep going on this. You're doing one for us in Tennessee. How are you going to get to Tennessee? Your wife's not going to let you go to Tennessee.
My wife's not going to let me go to Tennessee. No, she barely let me go to Long Island. She doesn't trust me. So pre-COVID, we did a physical site visit on every single property. Okay.
So you would send someone out.
Yeah, I have a team. We're about probably 60 people on the cost seg side between engineers and an operations team and a sales team and billing and today I'd say probably about 75% of our properties get a physical site visit. We send somebody down. Yeah, I've got an engineer in Atlanta. We've got a team based out of Lakewood. I've got a team in Detroit. We have somebody in South Dakota, Los Angeles. So geographically, I'm pretty well covered. I've got an office in Dallas, Houston, Cleveland.
Is there a benefit to having an engineer do it?
So every property is visited. We've got every single property is visited physically or virtually. So some of it is done virtually. Preference is to keep most of it physical. That's have somebody walk the property, pictures, notes, measurements. Obviously, we work with your floor plans, your appraisal, site survey, and we get a lot of the information off of there. I'd say that summer of 2020, post-COVID, so you really couldn't get on a plane. There's no other.
Yeah, I did find that way. I did find that summer.
There's no other way of getting it done, and we pivoted very, very quickly then.
Yeah, you guys did a great job.
Virtual. Thank you. We've pulled back on the virtuals. We certainly are still doing virtuals, but there's a lot of physical in there as well. Now, not every property can you do virtual either. If you have a 250,000 square foot office building with multiple tenants, you're not getting that done virtually. That's not possible. And again, the preference is preference is a physical site visit, have somebody walk the property. Some of the smaller properties, Airbnbs, virtual site tour, and you've got so much information online, especially if it's a short-term rental and they're looking to get those properties continuously occupied. It's not difficult to get the information they need online, but every property gets a site visit.
You said this to me, but I didn't know why. But is it better to have you guys do the cost seg before I do a huge reno or after, and then why?
So that's a great point, Brian. And my suggestion and my advice to prospective clients and to clients is buy the property and then keep it in service for a year or so. Generate rental income out of the property right out of the gate. You buy the property, get some rental income, have tenants in there, file an initial year tax return. Okay, do the cost seg study on the initial year tax return. So break it up, get the depreciation benefit, and then in the next year start your renovation project. Don't start the renovation project right away. And then, and then when you do the renovation project, you'll be able to what we call a write-off study. Okay, you'll be able to identify, because you had done a cost seg study when you first bought it. So now I come in there, I got my kitchen, I put in new appliances, new vinyl tiling, there's new cabinetry, new countertops. I could write off whatever remaining benefit was left in those assets before I started the demo project. They're gone now, and there's no depreciation recapture on that, which is something that we didn't cover. So you'll get immediate benefit off the write-off, and then you'll put your new assets on the tax depreciation schedule. So instead of having 2 refrigerators and 2 ovens and 2 sets of countertops and cabinetry sitting on your depreciation schedule, you actually did the cost seg when you first bought the property. You wrote off whatever remaining value was left, which is probably not much, but there's still a little bit of something in there. And again, it's not subject to depreciation recapture. And then I have the new oven or the new flooring that's going to get depreciated fresh. Okay. Something that we didn't discuss is depreciation recapture. We had discussed doing a 1031 exchange and referring your income tax liability. But if you do sell the property, there's always depreciation recapture. So any property that you sell and you've depreciated, so you've taken these losses against ordinary income. That's your depreciation expenses at 35%, right? As opposed to, so I've used it to offset ordinary income. Now I go and I sell the property. So let's say I bought the property for $1 million. I depreciated it down to 0, and now I'm selling the property for $2 million. So from 0 to $1 million, I'm going to pay depreciation recapture rates. From the $1 million to the $2 million, I'm going to pay, providing that I hold the property long term, I'm going to pay long-term capital gains rates on it. So if you anticipate selling the property right away, I would suggest don't do the cost seg study, because you're going to do the cost seg study, you're going to pay my fee, and then if you're selling it for cash, I mean, 1031 exchange, you're fine. But if you're selling it for cash, you're just going to get nailed with immediate depreciation recapture right afterwards. So I would suggest to avoid doing the cost seg study if you anticipate selling the property right away for cash.
Okay.
Yeah. Really more for a long term.
It's a long-term hold, exactly. And it's
or an anticipated 1031.
Or 1031, exactly. It's time value of money. It's not, there's no extra depreciation. You're just taking your depreciation faster.
Explain to me how you take the land cost out and then what you're left with.
So the way you're supposed to do your land cost, and everybody listening out there, is go to the county records and see where the county has land at. And sometimes you're surprised, but you go to some of these locales, like these real expensive cities, and you're gonna have land like 80%. But that's you could get a land appraisal done. I don't think it's gonna come in that much lower.
You want the land to be lowest or highest?
Well, you want land to be honest. That's really where you want land to be. And we've heard from accountants that there is a slight uptick in audits on land allocations. You want land to be where land should be at. So if land's at 13%, and put land at 13%, sometimes you'll see land will come in at 4% or 5%. You can look at comparables, see what the neighbors have.
What a piece of land would potentially trade for.
Exactly. So as long as you get back into your number and you have something, God forbid, in case you're audited, and there's, you have what to rely on, then you're good. But
so you basically, we'll use my primary residence, but I can never use it. A lot in Setauket could sell for $300,000. The house is worth $1 million. So basically we remove that $300 immediately, and then you're left with $700,000?
Correct. Yes. Sometimes you just see it like so flipped upside down, where, the house is $1 million and the lot sells for $800,000. So you're not really left with any basis. Yeah. I've seen many accounts, and I'm not implicating anybody, but I've seen them go with like they just, it's an allocation, 15% 20%, 25%, 30%. Personally, my advice, my suggestion is be prudent about it. Do your homework, work with your accountant, work with your county, see where land should land at, no pun intended, see where land belongs at. And then, then based on that, see what your depreciable basis is, and then take the cost seg study from there. That's my professional advice. I've seen, too much disappointment where, people have gone with 15% land allocation and it's come back to hurt them at some point.
Absolutely. Moshe, you are the most interesting person in the room.
Oh, wow.
I really, truly believe that for real estate professionals, for real estate buy and hold investors, where can people find you? How can they get in touch with Madison Specs? Like, what's the best way to get in touch with
So really, just our website, madisonspecs.com. If is there a way for me to share my...
all your stuff. Our engineer is going to set you up with all of any social emails will go on all of our posts. But if you want to give a phone number, an office number.
732-333-2679. Corporate office is in New Jersey. We've got office in Cleveland, Dallas, Houston, New York City. Geographically, we can hit all 50 states. We've done work in all 50 states. I want to do that site tour in Alaska.
Oh, yeah.
I didn't make the cut. And we've done a bunch of properties in Hawaii also.
I would have rather done to Hawaii. I definitely not going to Alaska.
We've done a whole bunch of work in Hawaii. I've done some hotel work. We've done low-income housing out there. Some of the low-income, the light tech credit work. We've done that out in Hawaii. We've done Wyoming, North Dakota, South Dakota. Interesting, a bunch of years back, there was during the shale boom, the oil shale boom. So North Dakota was a hot housing market for multifamily. And people were paying per door. They were paying in New York City. It was, they were bussing in people to...
Really?
Yeah, like able-bodied people to bring up that oil. And we had some clients that bought a bunch of multifamily properties out there.
I wonder what they're worth today.
California is a big market everywhere. So really, again, 732-333-2679. And, I'd love to be a resource, answer any questions, help you determine if you're eligible for a cost seg study, and if yes, how much depreciation you can pull out of it.
Guys, this is someone you should have in your team, without a doubt. I have my accountants, I have my attorneys, and then I have Madison Specs, because we all need to work together to, mitigate my tax liability and what's the word? Defer my tax liability as long as possible.
That's it.
And that's really the key. And I'm so interested by this stuff, and the knowledge that you hold in that brain is just incredible. And some of the mic drops that you put in this is definitely going to be the Airbnb for people. Also going to be if you run your business out of a building that you own. There's another huge opportunity for people. That's it. Anthony, anything else you want to ask this expert?
I appreciate all the information, and thank you so much for joining us.
Thanks for having me, guys. Thank you, Bryan. Thank you, Anthony.
Yeah. Thanks, guys. Listen, if you are interested in multifamily real estate, please like, subscribe, share this show. If you're someone who's interested in being a passive investor into syndication and you are an accredited investor, we'd love to speak to you. This is the Brick to Brick podcast, and we will see you next time.
Awesome. And you kept your eyes on the thing.